World's third richest man, Gautam Adani, is looking to raise funds. Last Friday, his group's flagship company, Adani Enterprises, said it will raise fresh equity worth 20,000 crore rupees by March 2023. The proposed fundraise, which is a follow-on public offer or FPO, comes at a time when the group is aggressively expanding into sectors such as cement and healthcare. It will be India's fourth biggest capital raising program and the biggest via FPO. And it will likely address concerns about the group's elevated debt levels and large promoter shareholding. But what is a FPO? Simply put, FPO is the issuance of additional shares by a company whose shares are already being traded on stock exchanges. A FPO is different from an IPO or an initial public offer, where a company floats its shares for the first time on a stock exchange. In comparison, already listed companies usually announce FPOs to raise equity or reduce debt. Typically, the issue price for an FPO is lower than the prevailing market price. It is done in a bid to get more subscribers to the issue. There are three types of FPOs: dilutive, non-dilutive, and at the money. A dilutive FPO is the one where new shares are issued, which leads to an increase in the company's outstanding shares. This dilutes its existing shareholding pattern. Adani Enterprises, for instance, is considering a dilutive FPO. However, since the proposed equity issuance is worth less than 5% of its current market capitalization of 4.45 trillion rupees, its equity base and earnings per share is expected to dilute by 5 to 6% at best. This, according to analysts, would not have any major negative impact on its share price. On the contrary, a non-dilutive FPO entails the issuance of shares that are already in existence. This means that directors or promoters will sell their privately held shares in the market. Thus, there is no increase in the number of shares for the company. Meanwhile, an at-the-market offering gives the issuing company the ability to raise capital as needed. That is, if the company is not satisfied with the available price of shares on a given day, it can refrain from offering shares. Most companies do not prefer raising funds via FPO now, as the process is cumbersome and involves higher distribution costs. Companies also have to organize numerous roadshows at different locations. While FPOs were popular in the early 2000s, there have not been many FPOs in India since 2015. Before Adani Enterprises, Patanjali Foods, earlier known as Ruchi Soya, had raised 4,300 crore rupees through follow-on public offer earlier this year. Prior to that, Yes Bank had raised 15,000 crore rupees via FPO in July 2020. So, are FPOs worth subscribing to? From a risk perspective, investing in an FPO is safer as investors already know the company, its management, and its financial statements. Moreover, since FPO prices are lower than market prices, investors have short-term arbitrage opportunities. That said, it's always important to do an in-depth analysis of the company before investing in it.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.